Okay, so in this video, we've got one of our team members here at SMB who's made a playbook presentation about an option strategy known as a long straddle. I want you to pay particular attention to the excellent checklist that he's put together in order to take advantage of an inefficiency in the marketplace where the options market makers consistently underestimate the move of IBM after earnings.
So hello, my name is Yanni, and this is a trade that I took on IBM, and I call this play the B straddle. So what is a straddle? A straddle is a neutral option strategy that involves simultaneously buying both a put option and a call option for the underlying security with the same strike price at the same expiration date. A trader will profit on the long straddle when the price of the security rises or falls from the strike price by an amount more than the total cost of the premium paid. Profit potential is virtually unlimited so long as the price of the underlying security moves very sharply. During early earnings season, it is possible to find underpriced straddles with proper preparation.
That's technically true on expiration day. Before expiration day, you can have profit in the trade anyway, even though it has not moved the full distance of the cost of the straddle.
Of course.
You see what I'm saying? Because of time premium.
Yeah.
Right. Okay, good.
Yeah, we'll get into that in other slides, but this is just a basic understanding of what it is. But this is typically at expiration, you're right. So the trade strategy is we find a liquid stock with a highly anticipated earnings that historically moves greater than 6 to 8% on average after they report. The average move for their past earnings must be greater than the implied volatility for the stock. The lower the better, and this is a way we could avoid IV crush. The option must have more than a week's worth of time with the lowest premiums possible, and the company cannot run up 2 to 3 weeks into earnings. Sometimes the company can make their earnings move before earnings, leaving us with little volatility after they report. So what I look for is a flat chart pattern, some short interest. It doesn't have to be crazy for the stock, but I like to see some. Elevated RVOL on the earnings report, a hot market and sector, volume on the breakouts, and shallow pull-ins. So when the stock reports the next day, we usually cut the losing side of the trade, and we look for a reason to sell the winning side of the trade. And if the earnings report is unusually good or bad, we look for a reason to sell.
Yanni, I had a couple questions about that,
Sure.
your strategy. And the first one is, when you say the average move for their past earnings must be greater than the implied volatility for the stock, that says to me that you think there's an edge where the market may be underestimating the potential move after earnings, right?
Mm-hmm.
Okay.
Essentially, yeah.
So is it possible that on the one hand there could be an edge with that? On the other hand, is it possible that the reason it's lower is because the market has some reason to believe it's going to be lower this time?
Mm-hmm. That is very true, and we'll get into some back tests as well. But typically with this formula and a few back tests, there are some scenarios where the market maker is actually just underpricing their bets for earnings, and we could actually capitalize on a surprise report. So in this specific case for IBM moves a lot more, and the last few quarters they move way more than the implied volatility.
Right, and that's another thing that a lot of people look at is stocks that are consistently out moving the implied volatility, right before earnings, and that often is seen as something with edge too. So it's very similar actually to the concept you've come up with, except that people look for any stock where in multiple quarters in a row the implied volatility has either been a lot more than expected, or if you want to take the short side of it, a lot less than expected.
And I find that this pattern also works particularly well in early earnings season. Towards the end of earnings, I find that my back tests don't come back as positive as early earnings season. but we'll get into that.
Why do you think that because it's run up 2 to 3 weeks before earnings, that doesn't leave much chance for volatility right after earnings? Why are you saying that?
A lot of the times when companies run up before earnings, say that hypothetically the implied move is like 5%, but the next few days it's moved up 10%. Usually the IV will be much, much higher. So that's just something in my criteria that I look for, that I want to see a flat chart pattern and something that historically has moved.
Okay, it's almost like the volatility took place before the earnings report, and so there's not much icy. So it's really, could you have said the same thing for running down?
Yeah.
Yeah, okay,
Exactly.
got it. So in other words, if the move that you expect after earnings happens before earnings, then you may not get much after earnings. Is that kind of the theory?
Exactly, yeah.
That's interesting. Okay.
If you want to learn 3 more real-world setups that our traders use, including the simple setup that we teach all of our new traders, and the setup that turned one of our traders into a 7-figure big money earner, check out the free webinar that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open up the free registration page in a new window, so don't worry, you won't lose this video. You can also visit tradingworkshop.com to register for this free intensive workshop. You're going to learn more in a couple of hours from this trading workshop than from years of online education.
So these are the back tests that I've ran with this specific strategy. This is just 10 years of raw data for IBM, where we would just buy one at the money straddle at the close before earnings and sell it the next day after they report. Completely without discretion, just automated back test, right?
On the open, you close it on the open in your back test, or when do you close
Yeah.
it? On the open.
So close before earnings, sell the next day after they report. So these are the results for 10 years back for IBM. And I also made sure to make sure that there's not a lot of outliers. Sometimes like you could find companies that have these amazing earnings moves, but it's only once. So I try to find like consistent growth with this type of back test, right? So these are the results for the last 10 years on IBM, and the results are pretty good.
Yeah,
right?
so it's almost 40 instances, right? And what are
Yeah.
you saying is the percent return? Is that over the 10-year period, or?
Yeah, over the 10-year period, this is the cumulative return. So the average return is 21% per trade, and over the 10 years, it's returned 1,000%.
That's over 100 a year.
Another back test I like to do is check the last 12 earnings to make sure that there is a pattern. So on the right side, you could see that similar back test, just the returns of the straddle price before and after earnings. And on the bottom left right here, just noting that the implied move weekly is 5%, and the average max move over the last 19 years is 6.6%, with the last 12 earnings being 6.8. And here are the returns for the last 12, when the implied volatility was less than historical. So when it's higher than that, I typically would not want to take the trade. So there were 6 wins, 3 losses, and 3 instances where I didn't trade in the last 12 quarters, with an average of around 18% almost for each trade.
And in other words, they did not meet your criteria.
Yeah, there was three times where the implied volatility was just too high to take it.
Now, have you done back tests for other than IBM using these same basic principles?
Yeah, some names that also are pretty positive are Netflix, UPS, and Intel. And also this week's stuff that I'm looking at is Qualcomm and Twitter as well. But there is a few instances where this works for multiple companies, not just IBM.
Would you say IBM is the one that's given you the best results from what you've seen so far? Or?
Oh, yes. By far the best has been IBM, but both Intel, Netflix, also Cisco, I forgot to mention, very positive.
Do you have any, I mean, what you're basically implying here is that the market over time fairly consistently underestimates the moves that IBM is going to make after earnings.
Mm-hmm.
I mean, it's not, it's 23 out of 40 times. So what is that? 65%. and the percentage by which they underestimate it is such that if you're on the buying side of the straddle, you're going to make a lot of money, right? Do you have any theory on why the market hasn't figured out that IBM moves more than this?
I really can't tell you that, but what I think personally is that the market makers just underpricing the move.
Yes,
They
well,
think-
right. That's factually what you found out.
Yeah,
Right.
yeah.
Uh-huh. Yeah. I'm just kind of curious if anybody's ever figured out why this would happen over such a long period of time.
Yeah, I'm not sure, but there is some instances, as you can see,
Yeah, of course. 23 times, or 16 out of the times, they overpriced it, theoretically, right? Yeah.
Yeah.
Okay.
Okay, so moving on, just a quick back test based on the statistics we saw. So say we were to take this trade 100 times, the expectancy is pretty high. Another criteria that I want to start looking for really all my trades is if the risk reward is there. It's not enough to say, okay, this could maybe work this quarter. If I'm going to take this trade 100 times, I want to see that it's going to work 100 times. So that's just what this back test is telling us, that with a win rate of 59% and the average size of the win and the loss, over 100 trades, it would be positive. So here are my potential reasons to sell the trade. So if my price target is reached, obviously I would take off the position. But if the trade goes against me, I look for an intraday uptrend to be broken, breaking news in the stock or the market, 50-day moving average on the 1 hour to fail, unusual seller on the tape, the daily Bollinger Bands to fail, or if there's mixed earnings results. A lot of the times, if earnings are just mixed up, nothing really happens, the stock could trade flat. So I use that as a reason to sell as well. I usually try to keep my position on if the stock has unusually good or bad earnings. So here's my trade plan. Just simply buy it at the money call and puts at the same strike. At the close, the day before earnings, cut the losing side at the open. I'm going to typically risk 10 to 15% on the entire position percentage-wise. Try to scale out into strength and use the potential reasons to sell.
The one principle that you talked about that I had a question about was cutting the losing side at open. Have you looked at what would happen if you didn't do that? Like in other words, you see, here's the point I'm getting to. If you have an option that is so valueless because the market has pushed so hard in one direction, then if you sell it at that level, it's almost like you're selling it at the worst possible time. Whereas if you get a retracement during the day or you get a big move coming back the other way, it can be very helpful to still have that. So my only point is, if you're cutting it when it has almost no value anyway, you're not really accomplishing that much. Whereas it may actually be helpful as a hedge. So in other words, if these options, if it was down to, I don't know, 5 to 10% of its initial value, I might keep it on just as in the event that you get a retracement, you'll get it'll basically act as a hedge for you against your other position. So has your observation been that just, your first loss is your best loss? In other words, if you cut it at the open, you're generally going to be better off than if you didn't cut it at the open?
Yeah, that's something to look at because there are times where the stock has retraced and it would be good as a hedge, but sometimes you could steal an exit because there's so much volatility in the first 5 minutes. Sometimes you could get a good fill, but yeah, that is an interesting
That's
point.
a great point because it's still, the unknown isn't totally unknown at 9:31, right? So
Yeah.
It's like you can kind of get out while the getting is good when there's still volatility in it. Yeah, that's it. That's an interesting point. I know some options traders who any option worth a nickel or less, they will never, ever close because all you need is one time out of 100 for one of those to actually gain value towards the end, and it's worth all the other ones that you closed. So it's just a kind of principle to think about, that nearly valueless long options may actually not be worth it to sell, because every once in a while they'll come in really handy.
That's something to look at then. I'll definitely keep that in mind. So here's our bigger picture for the SPYs. SPY is very strong. Dow is very strong. Qs are slightly less strong, and IWM was flat at the time. Most stocks are trading higher despite the new wave of COVID-19. ARC and growth momentum names are somewhat lagging at the time. Value names, financials, energies, Dow industrial names are leading the pack in this rally. And I like to call it a slow volatility, a low volatility environment with a slow grind higher, which means we have to be very selective. There will be very less aggressive breakouts. So that's something to keep in mind, that maybe day 2 or 3 may set up after earnings. And here are just some jobless claims and other economic data that came out that was pretty bullish at the time. Everything pretty much beat by a landslide. Sector strength, this is XLK. We have a pretty strong market. Dips are being bought back up. And overall leading the SPYs and the Qs, everything higher. So here is IBM on a longer time frame. This is the weekly chart. And we've had a steady downtrend since 2012, 2014. And we're just starting to test not higher prices, but we're starting to reverse potentially. So here is technical analysis on a 1-hour chart. What you can see here is that leading up to earnings, we did have a nice triangle consolidation with a breakdown, but very little follow through. And we just traded flat 3 to 4 days before earnings. And then when we reported, we just broke through that high and consolidated above this previous consolidation right here. So here's just a little smaller time frame, 5 minute. We get that 130 breakout. We continue to make higher lows throughout the session, and we have high R-vol with a strong open. And then the second day play, we look at this pattern, and people could say that it's close to the Dr. S pattern, where you just have this clear institutional buying, slight pullback, and then close at the high of the day.
Are you bringing in the second day play as a possibility of holding, for example, if you dump the put on the open on the right after earnings, would you still hold the call into the second day to take advantage of the Dr. S pattern? Is that what you're saying here, or?
Yeah, well, especially with the low volatility environments, I'm saying that sometimes these earnings plays could take 2 to 3 days to set up, and I'm just pointing out that there are other patterns in this trade as well. That it's not only just a straddle. That we learned in the Winning Trader that this is clearly a Dr. S pattern, where we just have this nice institutional buying. That's just an indication that the trade is working. You actually add more size potentially if you see that.
And I guess if you're adding size at that point to your call, your time premium will be helping you, right? Because these are what, like 1 week expiration trades? Didn't you mention it had to be at least a week later?
Yeah, it can't be weekly. Usually it's 2 to 3 weeks out, but it doesn't even have to be calls. It could even be equity you could add here.
Oh, I see. Right. You could
definitely make multiple playbook trades within this setup. If you want to take opening drive plays, if you want to add on the pull-ins, I think there's multiple trades that you could add here.
Because if you stay long the call, that's the concern I have. But now you're tuning me into the possibility that this could be done with equities after the straddle is over, right? Mm-hmm. You could just because you're going to be fighting both volatility reduction and time premium reduction. With the long call will be shedding its time premium. So if you think, if you really want 100 deltas that are not going to bleed on you, then you want to go with shares, most likely, right?
Yeah, exactly. But I typically never hold these calls more than 2 to 3 days. Like this very short-term trade, I'm not holding these to expiration, So here are the intraday fundamentals. If you guys don't know what IBM's business model is, it's the world's largest employer, one of the world's largest employers with close to 400,000 people worldwide. They have major research organization with the greatest number of patents for the last 20 years. and has a diverse portfolio of products and services such as cloud computing, cognitive computing, data analytics, IT infrastructure, and mobile security. And here are the earnings that they had. They beat earnings across the board, post revenue growth after the first 4 quarters of declines. And we have both earnings and revenue beats with guidance being reaffirmed. And down here are just some price reiterations from pretty big firms, Credit Suisse and Morgan Stanley, with pretty high targets compared to what it was trading at the time. And then the day 2 catalyst, they just had some news. I don't know if that is really relevant, but and here are the statistics. The average volume is 6.71 million shares. R vol is 2.3. ATR 2.32. Short float 3%. Shares float almost 900 million. Institutional ownership 58%. Insider ownership very small, 0.10%. So here are the variables that we talked about and pretty much met the criteria for the trade. Liquid stock with highly anticipated earnings, elevated R vol, volume spikes into the breakouts, lower implied volatility, volume on the breakouts with shallow pull-ins, decreased volume into the pullback, low IV option with more than a week's worth of time, some short interest, flat chart pattern. We held until there was a reason to sell. And obviously technology sector and the market has been pretty hot recently. And we also saw some buying near the VWAP on day 1, which is another check in our favor. So here's our profit matrix. So we got the 30th, April 30th, 133 calls, which were at the money at the time. We're basically risking technically $680, but we're probably going to cut before expiration. So on day 1 or 2, we want the trade to be somewhere around here. It doesn't matter if the stock falls or rallies off earnings, but we do not want to hold it for expiration. As you can see, if it trades flat into expiration, you pretty much lose the whole entire trade. We want it to be very directional early on.
And now you can see why some people like to do the exact opposite of this on stocks where the market has consistently overestimated the move, right? Because basically that red loss area that gets larger and larger and larger as time keeps decaying out of the options. The bet with those kinds of traders, the short straddle traders, are that area is much wider than it needs to be, and you'll make money anywhere in there. So it's like opposite thinking to what you're doing, but there's lots of stocks where the market is overestimating on a consistent basis the same thing. We noticed back in, when was it? In the earlier part of the day, 2010, 2015 era, Apple would very frequently, the market makers would overestimate the move, and it was a great trade to do a short straddle on. Whereas you're basically looking for long straddle plays.
Yeah. And I also have a portfolio of like other option trades that I like to take. I love to do like iron condors and credit spreads for earnings as well. But having a mix of both, I think, is a perfect balance,
Yeah. Well, then you can take advantage of your research either way, right? If you pick up a group that overestimates and another group that underestimates, and you can play them both in there, accordingly.
Exactly. So here's my trade management. I buy the straddle midday when the market is choppy and premiums are low, and virtually there's no price change towards this point of the day. We dump the puts, but maybe in the future I look to keep those puts on, but that's just the execution right here. I scale out 1/4 when it makes a new high, 2/4 as it failed to make a new high, and at the time I thought this was a reversal, so I took off some risk into here. I sold 3/4 at end of the day when we saw that clear institutional buying. And then the next day we got that quick pop, and 145 was my target, and we nearly reached that, so I just took off the whole entire position. There's no
Good
reason
timing.
to penny pitch. Yeah,
You and everybody else in the world had that as a price target.
yeah. This would be my ideal trade management. Maybe instead of selling the puts off open like we talked about, we'll get rid of that. But potentially adding right here when it held that support again at 140 or 141-ish. That might not be another spot to add. I'm not sure. I have to back test a little bit more. I don't want to squeeze out like too much from the stock. One of the pros of being an active trader is that we could be nimble, so I don't want to stick around too long. But we just have to see how the stock develops. Maybe this trades much higher. Like if we saw like a longer term chart for IBM, you could argue that this could be a $200 stock in 2-3 years, you know, but I have really no interest in holding for that long. So, okay, here's reading the tape. This is the 140 area that was pretty important. If we go back, this was the area that I was talking about right here, this new high. Support and inflection point. Once we broke it, we came back into it. So I just want to show the tape from there. So here's the test of 140. Again, big size of that 140. Lots of shares. Some on the bid as well at 95. Break that level. Tape starts to speed up.
This is still on that first day, right?
Yeah. Or no, this is the second day
This is
actually.
the second day.
So we have a pretty decent amount of shares holding the bid. So we held that level, and now we're later in the day we're gonna retest that 140 break. So we leak under that with a lot of asks. We rebid that level. So we're still trying to hold this 140 level. Then once we built above this 10 cents, from there the tape just kept continuing higher after that. So here's my trade review. What did you learn from this trade? I learned that I really love the backtesting aspect of this trade, and I want to keep testing ways I could find more setups like this. I really liked how options gives us the flexibility to be long volatility before earnings, and actually gives us a little bit more wiggle room in a trade by being a non-directional trade at first. And patience is key in current market conditions, that it may take 2 or 3 days for these types of trades to set up. How could you have done better? Do a better job with sizing when the trade is working. I think there was tons of opportunity for me to add size, but I just kept my current position. I took a lot off too quickly, which kind of messed with my risk reward a bit. And I need to be in a better mindset on day one of the trade. I'm so used to these trades working the first day. I was ending up a little bit stressed when the trade wasn't initially working. I would like to improve my self-talk a little bit more when it comes to day one. And how would I trade this differently next time? Like I mentioned, use some of my other intraday skills to add more cash flow to the trade. I have tons of other playbook trades and technical ways to add to my position with less risk. And I wanted to find a way to be hedged a little bit more since we have the calls. But like you said, maybe having the puts and never selling them could be the best way to stay hedged.
Another thing you can do to cut your risk is instead of entering into just a flat out straddle, you could enter a call debit spread and a put debit spread and pick price targets on both sides so that you likely won't run into that where you've located the short. You see what I'm saying? Mm-hmm. So
Yeah.
that will cut your cost because you're going to get back the premium that you're getting from selling the call much higher. So for example, 145 was your price target, right?
Yeah.
So if you had sold a 145 call, it wouldn't have mattered to you, right? Because you would have been willing to get out at that point anyway. And if you sold, and you could sell a one whatever put on the downside if you had a sort of a downside target as well. So that's one way to just immediately cut risk on this trade. Now you won't get the runaway winner if you do that, but if you put it far enough away, you can get a really good run out of it. So that's just one. You understand what I mean by? It's basically a reverse iron butterfly is what I'm suggesting. It'd be buying an iron butterfly instead of selling one. So that would be one thing you could look at. And another thing is we've got this team of traders we call the Options Tribe Trading Team, and it's 50 traders who are sharing trades back and forth every week in presentations, very similar to this really. And one of our traders is doing short strangles on companies coming up for earnings where the shorts are located in a very safe location relative to previous moves. That's very, very close to your iron condor idea. It's almost, do you understand what I mean?
Yeah.
Yeah. And so that may be something you'd want to learn about. If you want to get in touch with me afterwards, I can get you in touch with her so you can understand her technique. But basically, she looks at the previous whatever number of earnings and then sells a straddle that's well beyond the biggest move it's made in the last whatever 5 years. And that way, if the market stays inside there, it's a really good win because you get a huge vol crush that next morning if it didn't move anywhere near those short strikes, which it usually doesn't, and then you just cash in on it. So the safer way to do that is with an iron condor, so you'll have a long call and a long put on either side. And it sounds like you kind of already know about that concept, but she does them way out, like way out. So the risk of getting hit's really small. So these are small wins, but you can always scale it up. So I would just encourage you to, since you're doing the research anyway, if you come up with certain stocks where the move is significantly lower than the market keeps anticipating, then you should think about a way to play the other side of that, like an iron butterfly, which is almost exactly the opposite of what you're doing, except you just don't have the other, the strikes on the other sides.
Because typically what I would like to do if I'm looking for a stock like this and it's completely the opposite, I would try to look for an iron condor or credit spread even.
Yeah, but the biggest win will be with an iron butterfly because you're getting so much premium. Right before earnings, you get this massive amount of premium. So, but it's in a dangerous trade, obviously, because if the market did estimate it correctly this time, you're going to lose on the trade.
Yeah.
And of course, the big danger of this trade is the stock just doesn't move, and then you have the opposite problem. It doesn't move, and then you get a huge vol crush, and so you may not totally be able to control your risk all the time. If you get a big enough crush, you'll go past your stop, but that's the risk. You can't have it both ways, right? You either have the potential of a really big win, or sometimes you're going to have the market's going to gap past your stop, and there's nothing much you can do about it.
Yeah, and that's why I try to build such a strict criteria to find stocks like this. I'm going to be very selective going in the future, just so I could avoid that IV crush.
Yeah, right, exactly. And I would also say you don't want to put a ton of capital. You don't want to load the boat on a trade like this because it's got, it's got a lot of risk in it. But with that risk being that it just doesn't move that much, right? And then you just get this huge vol crush. And I'm sure you've seen that now and then too. So, you just want to understand that it's a trade that has a lot of risk in it and a lot of reward in it.
Exactly. That's why sizing is so important with this, and why I mentioned that there's other ways to add cash flow to this trade. So remained a little bit more hedged. Like I could have easily scalped the open a few times with this IBM. There was many pullbacks where I could have added, just so I stay a little bit hedged,
And so I agree. I think, Yanni, if you're sitting down, I think you did your checklist is excellent. And if you sit down and you do the work on these kinds of trades, that's your edge, right? Because a lot of other people aren't doing that work. You're sitting there, you're focusing, you're identifying a list of aspects that make it more and more likely you're going to win. And then, you have the courage to actually take the trade. So, it's an excellent checklist as long as the market doesn't come up with the underpricing it keeps seem to be offering on, it's over with IBM if they start to basically bump it high enough so that the implied volatility is equal to previous volatility. Yeah. But then you can move on to another stock where they haven't caught up to it on that one.
Yeah, exactly. So constant backtesting is key.
Yeah. Yeah, I think you should have a basket. I think you should have a basket of these that you're looking at, all the time. You probably need, I don't know what number, 20, 25 of them that you're studying, and you can play each one of them 4 times a year. Not that you will, because a lot of them aren't going to meet your checklist, but you need a kind of a decent stable of these, because the market getting volatility wrong over and over and over again is probably less likely to happen over time.
Of course.
Yeah, because people get burned. They remember getting burned, and they make sure to price it up the next time.
Of course. Hopefully the market makers are not watching this presentation, but.
Yeah, we don't want to. Believe me, they're quite aware of this. Really, really nice job.
Great.
Nice job on that,
Great.
Yanni.
Thank you so much, Seth.
Hey, go ahead and click our subscribe button so you don't miss any of the videos they're producing for you in the trading community. And please take the time to add your feedback in the comments section for what videos you'd like for us to produce next and what you found helpful from this video. From all of us at S&B, train and trade well.